Hi everyone, I'm Meghan Pinchuk, Chief Investment Officer, Morton Wealth, and I'm joined by our CEO, Jeff Sarti. We are here to do our second quarter market review as normal. And we're gonna go ahead and get started talking about asset class performance, how things are doing year to date, but a little bit more chart heavy than I think we've been in the past few quarters, just because a lot going on, tariffs, the dollar, inflation, a lot of economic buzzwords in the headlines. So we'll try to break some of those down for you. But starting with the asset classes and that performance, the S&P 500, so U.S.
stocks,
U.S. large companies were up about 6% for the first half of the year. And that doesn't really tell the full story, because that's actually that's a nice solid return for that period.
It's been a roller coaster ride, yeah.
It was wild. So actually from the peak, as the high that those stocks reached, there was about a 19% decline. And then since then, obviously recovered and back to previous levels.
And that was that decline was over a very quick time frame. I think it was from like early February through early April, Liberation Day, with the tariff announcements. A really steep drop of close to 20%.
Yeah, and a lot of the recovery has been on, I think, talk about the potential for tariffs getting delayed, or there's still a lot of uncertainty related to that, but there's been a strong recovery, no doubt. Interestingly, international stocks, outside the U.S. have actually performed very strongly in this period of time. And so we're going to get a little bit more into that, but those are up close to 20%. And that's not an annualized number, that's just for the first 6 months of the year. So I don't know, but bonds are a bit of a different story, but if you want to jump into that.
Yeah, great first half, good first half for U.S. stocks, great first half for international stocks. Bonds have done decently well. They're up call it about 4% for the first 6 months of the year, so pretty solid return. But that also doesn't tell the whole story. It's actually been, if you look back longer term, a pretty tough bond market. Going actually back 5 years, we've been in a bear market. So what I mean by that, literally, if you bought the broad-based bond index 60 months ago, 5 years ago, you would still be in negative territory in terms of total return. So yes,
that's the safe asset class.
That's a safe asset class. So yes, making income along the way, but the price depreciation, because interest rates, as we all know, rose, call it 3-4 years ago, you would have negative performance in bonds. So pretty tough performance in bonds. We really largely avoided that, to some degree, calamity in bonds. Our bond funds have done really much better than the broad-based bond index. We largely avoided duration or interest rate sensitivity risk in recent years. But then even more importantly, we just have less in bonds and more in the way of bond alternatives. And we'll talk more about those bond alternatives later in this discussion. But our private lending has continued to march to the beat of its own drum, making, call it, high single digits year after year over those last several years.
Great. And so just to dig in a little bit more to international stocks, because we've gotten that question of like, well, why?
Right.
Why is international outperforming U.S. by so much? And so I think there's a couple of things that we feel feed into that. The first one to start with is actually valuations.
Yeah.
So looking at, we're going to go ahead and share a chart here that looks at the PE ratios, or it's a valuation metric, basically how expensive or cheap are stocks. And we're going to look at this and say the red line is the S&P 500, and it's tracking, again, the valuations on the S&P over about the past 15 years. And the blue line is the international stock index. And so you can see that in the beginning, they actually go fairly parallel to each other. They track fairly closely. And then in the last few years is where you've had this big divergence, where U.S. stocks have gotten a lot more expensive, while international stocks have gone down or sideways.
And there's some validity to why U.S. stocks should be determined or valued at a higher multiple than international stocks. We're the leader of the free world. We are the safe haven asset, so that makes sense. But to your point, that discrepancy in recent years has really widened drastically.
Yes.
So
it's gotten very large. And so that's one piece of it, just is that you're starting from, I think, a more attractive place on international stocks. So we've had an international stock allocation for some time. And this period of time when there's been a lot of volatility, especially in U.S. stocks, it's been a nice diversifier, actually. Right. The other big thing that we've been tracking or focused on is the impact of the U.S. dollar on international stocks.
Yeah, so that's the second big component. The U.S. dollar, after many years of having a strong run of a strong dollar, year to date, call it through the first 6 months, is down about 9 or 10%.
Which is a big move for a currency.
It really is a big move for a currency. So not great from a domestic point of view, but if you're an investor in international stocks, that's pretty strong. And why is that? It's really just math. It's a currency exchange argument. And I think the best way to think about it is If you're a foreign traveler, let's say you're going to Europe and you're excited to buy a foreign good, let's say you're shopping for clothes or maybe a fancy purse, would you rather have a stronger dollar or a weaker dollar? And of course, you'd rather have a stronger dollar because you then will convert those dollars into a cheaper euro and be able to buy that Chanel purse. I don't know if you buy Chanel purses.
I don't, but I feel like there's a trade-off here. My international stocks are worth more, but my Chanel purse is more expensive. Right. Is that what you're telling me?
So that Chanel purse would be cheaper if you have a stronger dollar. The opposite holds true. If you have a weaker dollar, which we currently have, you cannot buy those foreign goods on sale. So that's what's happening. Just like buying a purse in France, if you're buying an international company or stock, because your dollars are worth less, that stock, the price of that stock, just like the price of that purse is more expensive, that price of that stock is more expensive. And so that's just part of it. It's an it's currency exchange rate issue more than anything else.
And so I think this issue, though, with the dollar is something now that is starting to get the dollar debt deficits. It's starting to get a lot more play in the headlines, but it's been something we've been talking about for a very long time. And the concern being, we'll get into a little bit more of the details of why, but the concern being that the dollar is weak because of our increasing debt levels. And so one of the reasons why now, because it's been increasing for a while, right? I think we just passed $37 trillion of debt. But I think there's more indication that the deficits are increasing. So deficit, they're used interchangeably, sometimes deficit debt, but in this case, deficit is more looking at like a 12-month period. How much did your spending exceed your revenue? And so that piece of it, right, where we've been accumulating this debt, there's been a lot of talk about, hey, we need to pare back, we need to reduce deficits, and we need to basically spend less. And that isn't happening. So now when you look at, I'm going to go ahead and share another chart, which looks at the deficit. So again, that annual spend over what we've actually collected. And so looking at the past couple of years, you can see fairly similar to each other, the two different solid lines, and both topping out at a little under $2 trillion.
That's 2023 and 2024.
Yeah, so we're basically increasing the debt by a little under $2 trillion for each of those years. But now on the dotted line, what you can see is that is all, it's only been part of the year, but we are meaningfully outpacing that now in terms of spending. So when the dollar is out there, where people are looking at the dollar and they're looking at all of the spending and even the talk of like, hey, we're going to cut and then we can't or don't, what does that mean for the currency and people's interest in buying it?
Yeah, so that's a big reason we believe of why the dollar is being challenged currently. And somewhat tied to that, and one of the concerns tied to the weaker dollar is interest rates. And interest rates have stayed somewhat elevated. And there's a lot of concern of if the economy does weaken, will interest rates come down with a slowing economy? And not necessarily. And part of it's because, again, concerns around debt, concerns around inflation. And this gets a little bit technical, but I want to tie together the conversation around the dollar and interest rates, and they are typically very linked. And what I mean by that is if you have higher interest rates, let's say on a US government bond, compared to lower interest rates, there's more demand for that debt. People, if you have, let's say, a US government bond at 5% versus 3%, of course, more people will be interested in buying a 5% bond than a 3% bond. So there's more demand for that US government bond. You need dollars to buy that bond, so the dollar will appreciate in a higher interest rate environment. Again, the dollar and interest rates move together. Opposite holds true as well. In a lower interest rate environment, there's less demand for those treasury bonds, so less demand for dollars. So the dollar will weaken over time. And this is normal, this goes through cycles. And we'll pull up a chart to show this, and this chart shows the pattern of both the dollar, that's the dark blue line, and interest rates, the light blue line over the last 5 years, and these cycles hold together. But you'll see on the far right side of the chart that something different is happening here, where there's a disconnect, where we still have higher rates haven't come down, but instead of having a strong dollar associated with those higher rates, the dollar is weakening. And what is that saying? It's saying despite these higher rates, there's actually potentially not as much demand for those bonds, for our debt. And that's concerning, right? Is there too much supply? Is there not enough demand to purchase that debt at an attractive interest rate?
Yeah. And so digging into those, so it is very fun, supply demand, right? Is basic economic type of principles, that does play into the dollar. And so now looking at this and just thinking about that in balance, back to the debt and deficits, we have a big increasing supply of dollars basically coming online.
And it's massive. It's massive. You mentioned $37 trillion of total debt. The amount of debt this year that we have to issue, it's $8 trillion. The way that's broken down is it's $6 trillion of debt that's maturing that we have to refinance. And then an additional $2 trillion
Deficit.
that you mentioned, the deficit. So it's the 6 plus the 2 is $8 trillion of new debt that's going to hit the marketplace.
So someone has to buy that.
So someone has to buy it. So the question is there enough demand? And there are signs potentially that there's not quite enough demand. One even quick example, Canada in April alone sold $50 billion of our treasury, of US Treasury debt. They're one of the largest holders of our debt at $50 billion. They hold $500 billion of our debt. So they sold 10% of their holdings of US government debt. That was during the little spat between Canada and Trump with over tariff-related issues. But the concern is, will other countries behave similarly? Are they all already behaving similarly? Are they buying less of our debt? Are they even selling some of our debt? And if so, will interest rates rise on our treasury debt?
And I think there the question also is what percentage do they actually own? And so there's different numbers floating around, but it looks like it's about 30% of treasuries that are outstanding are owned by foreigners.
That's incredible. I mean,
big
they own
number.
about a third of our debt. Yeah, we're very dependent on them.
Similarly, about 30% of our corporate bonds, so company issued bonds, also owned by foreigners. So similar idea, right? If they stop buying it or start selling it, do rates go up for companies to borrow at? And then one other point that people don't think about as much related to this, because again, this is getting some coverage in the news of like foreign ownership of bonds. The stock market actually. So our stock market has a fairly also large percentage of foreign ownership. About 20% of the S&P 500 is owned by foreigners. So I think there's definitely talk about, do people start selling? And that can certainly happen where they sell. I think it's probably not in a lot of these countries' best interest to go just dump treasuries as an example. It hurts them as well as us. So that's probably not the most likely scenario. The flip side is even if they don't start selling and they just don't buy the way they've been buying, that's going to really hurt things from a demand standpoint. Similar to stocks, right? We've seen a tremendous stock market growth in the past several years. A lot of that is a lot of money flowing into stocks. So even if that upward movement isn't there, how does that impact prices?
Yep. So something we're definitely obviously keeping an eye on. Shifting gears a little bit away from asset classes, let's talk a little bit about the economy and inflation. So specifically with regards to the economy, our GDP growth has been kind of floating along at roughly a 2% rate going back several years. And we'll pull up a chart here that shows GDP in the dark line, economic growth versus inflation, which is the more pale line up above near the top of the chart. And you can see, again, going back, this goes back about 2.5 years or so, GDP humming along at about a 2% rate. It's weakened of late. Not doom and gloom. We're not quite in recessionary territory, but there are signs of weakening economic growth. Everything from credit card delinquencies are up, auto loan delinquencies, things of that nature. Unemployment statistics are weakening a little bit as well. And then there's concerns around tariffs. Have the effects of tariffs filtered into the underlying
Are those
economy?
actually going through yet? So.
And most economists think that's still coming on the horizon as opposed to filtered through the economy as of yet. So there are concerns that we are in a soft spot on the economy. But the flip side, let's look at inflation. And as this chart shows, inflation's been kind of sticky in the 2 to 3% range. But of late, it's been picking up a little bit. And again, as maybe some of that is debt-related issues that you hit on, tariff-related issues. But the concern is the gap that you see here on the right side of the chart, the widening gap between inflation and a slowing economy. Typically, when you have a slowing economy, you have reduced inflation, maybe even deflation. Things are slowing down, prices are not going up. This is an interesting dichotomy here where we have potentially somewhat of a stagnant economy coupled with higher inflation. The term's been thrown a lot around the media, stagflation, and that's what that means, stagnant growth on the economic side coupled with inflation. The last time as an economy we really saw that was the 1970s. And the concern is, are we in for a similar dynamic with regards to our economy? And that's a challenging environment for lots of investments, specifically a stagflationary type environment.
And so we want to dig into that a little bit more because we do think about this a lot of the different scenarios. Because look, the reverse could happen too, right? The chart that you showed, they're beginning to diverge. It could come back together, right? You could have different things. So we're always thinking about what are what are the different things that could happen with growth, with inflation, and how would traditional asset classes in particular react to that? So I'm going to share another chart, and this one is trying to map out this scenario analysis that I'm describing, basically thinking through what are some of the different scenarios and what would that look like for asset classes. So what you're going to see is that on the horizontal axis on the bottom, that is looking at GDP growth or economic growth. And so the farther to the right, the stronger the growth. The farther to the left, the weaker. And then the vertical axis is inflation. So again, higher up is higher inflation. So 4 different kind of quadrants here to look at different scenarios. And I'll start with the Goldilocks scenario because I'm an optimistic, cheerful person. But that's the bottom right. And what you get is you get high economic growth in that scenario. And then you have low inflation. Right. So it's sort of the best of all worlds for asset classes, where stocks in particular, right? Stocks do great in that environment. Sure. Bonds do well too, because usually interest rates are about flat and bonds are profitable in that situation. So that's great for asset classes if you can kind of hit that.
Maybe a couple examples would be a lot of the 1990s were some of Goldilocks, pre the dot-com boom, which got into maybe a little bit of an overheated economy. But that was Goldilocks. A lot of 2010s, that decade was somewhat Goldilocks. Not great growth, but solid growth with low inflation. So typically pretty good for stocks and bonds.
Yeah. And so you mentioned overheated. So that's another scenario where you get high economic growth, right? Also the upper right now of the quadrant, high economic growth. But in this case, you actually have high inflation as well. So things are getting a little ahead of themselves. That actually is typically a decent scenario for stocks as well. Like the late 90s is a good example. Stocks maybe get a little ahead of themselves, but you typically get strong stock performance there. That, though, is a negative environment for bonds. Inflation's high, so usually interest rates are going up to help combat that, and then bonds mathematically are dropping.
Okay, perfect. So you hit on kind of the right side of the chart. Shifting gears maybe to the left side of the chart, which is in a lower economic growth rate environment, so lower GDP growth. We'll focus on the lower left side, which is a recessionary environment. Pretty straightforward, slow growth, low inflation. Obviously not good for stocks, right? Stocks don't perform well in a slow growth or recessionary environment, but typically can be pretty good for bonds. And why is that? It's really 2 main reasons. One is a lot of investors fly to the safety of bonds. They sell their stocks and buy bonds, so there's more demand for bonds. But in addition, the Federal Reserve or central banks typically will lower interest rates to try to stimulate the economy. And lower rates, typically rates and bond prices move in opposite directions. So that's good for bond prices. Moving now to the upper left quadrant, and this is the area of stagflation that we hit on previously. And this is a concern. An environment with relatively slower stagnant growth, but coupled with higher inflation. Not really good for stocks. One, slower growth, but second, inflation's not really good for stocks. There are winners and losers.
Certain companies do okay in that environment.
Right. There maybe are companies that can, instead of being a price taker, can actually make the price, set the price of their goods, maybe some commodity related industries, but generally speaking, not great for corporate America. But then also challenging for bonds, because in an inflation environment, we talked about in the beginning of this session, the last 5 years, higher inflation, higher interest rates, really, really tough for bonds. So now potentially we're in an environment where both bonds and stocks have been and can continue to be challenged. We always believe in diversification, right? Looking in for asset classes that will do well across a variety of these quadrants, but even more specifically in this upper left quadrant, stagflation, even more necessary to look for diversifying assets.
Well, that's obviously the bigger concern, since all traditional assets in that environment are potentially challenged. So just wanted to reshare really quickly, because we looked at this last quarter, so we don't have to spend a ton of time on it, but we had gone through this pie chart of what traditional portfolios, maybe like a 60% stocks, 40% bonds look like, or what's their sensitivity, right, to these different risk factors. And so just looking at this, the stocks are red, right, saying that they're exposed to the idea of low growth, recessionary kind of environments or high inflation. Those are both challenges for stocks. Traditional bonds we put in orange because, as to your point, if certain environments actually rates are coming down, that's good for traditional bonds. The high inflation one is the concern, because can rates come down in that environment? So again, that traditional portfolio, we feel very vulnerable to these risks. The flip side is the Morton portfolio, and where we're trying to really get diversified is a lot of the other asset classes that we're focused on are less sensitive to these risks. And that's really very intentional, where we're looking and saying we need to build in things that have different risk factors and are going to perform differently if these are the headwinds that we're facing.
And a number of the colors, as we show, are in green, where hopefully they'll perform well or hold their own in almost any economic environment. But there are some that will even theoretically thrive, especially in a stagflationary environment. And I will hit on gold, which is, you could see, as a slice of the pie. Gold is really designed to do well in a stagflationary environment. Gold's done very well for our client portfolios. Year to date, it's up, I believe, 20 or 25%. Gold mining stocks are up even more, call it north of 50%. So it's been really a wonderful run in terms of gold performance. But more importantly, from a longer term point of view, several years ago when interest rates started rising, gold really started, I believe, sniffing out these inflationary or stagflationary risks. And so gold's had a really nice run for, a handful of years now.
I think something you said is important too, that when we're looking at this, when we look at these pie charts, we're graphing out like how will they respond to these risks. Yeah. I think a lot of these asset classes that we really like, especially the private lending, and we'll share an example in a minute, they'll do well though in all of the quadrants, or that's the goal, right? Is you're trying to find things that will do well if there's a challenging environment with the stagflation that we've been talking about. But if you get the if things continue to do well, they'll also perform well in that environment. So if you can find something that'll hopefully be resilient across those quadrants, that's really the goal. So speaking of which, again, I think just maybe one example, we get asked a lot of this sounds great, but give us some specifics. Maybe you can share an example of a private loan.
Yeah, I'll share an example of a loan that we were just reviewing recently. Really interesting loan. It is an asset-based loan. As you know, we spend so much time focusing on collateral coverage on our loan, asset backing, but also it's in the healthcare space. Sector of the market that we like a lot from a diversifying point of view. Healthcare really, truly behaves differently than most other sectors. So this is a loan to a company, very successful company that makes generic drugs, specifically in the respiratory ailment space, think asthma, emphysema. Very successful company, over a 25-year history, makes over $100 million of earnings per year. So this is a very large, substantial pharmaceutical maker. They were refinancing their loan with their very low interest rate loan with their traditional lender. But it was at just a rough moment in time for them that was somewhat random in nature because the FDA just happened to release new guidelines, Federal Drug Administration, new guidelines around sterility requirements or cleanliness requirements for manufacturers of generic drugs. Not targeted to them, it was targeted to the whole industry.
The whole industry.
So to meet these guidelines, what did the company do? They were very proactive and they shut down their operations just for a quarter to basically fix their operations, buy some new equipment to meet these guidelines. The traditional lender, though, that was looking to refinance this loan, basically what do they look at? They look at cash flow, and they were saying, wait, this company's not going to be generating cash flow over the next quarter. They were not comfortable making that loan, but this company needed to refinance its debt. So what did they do? They went to other lending sources, asset-based lenders that obviously we really partner with, and the asset-based lender was very comfortable making a loan to this company. And why is it? It comes down to the asset coverage, really, more than anything else. This company, even without earnings, and there were earnings, I'll come back to that in a second, but tremendous collateral coverage from an asset point of view. They had a 700,000 square foot state-of-the-art facility, tremendous value in the real estate in the facility, state-of-the-art equipment.
A lot of it new.
A lot of it brand new. Accounts receivable, cash in the bank, and then a lot of inventory. I mean, a lot of drugs and other medications on the shelf that were easily saleable if the lender, in this case, had to foreclose on those assets. Now, that being said, the company is up and running. It's generating cash flow. It just took a quarter for them to get operations back up. They are in a little bit of a waiting game with the FDA. Typically, the FDA is going to come in over the next year or two and evaluate what's going on. Our lender has a high degree of confidence that they're going to meet those FDA standards. But even in the slim chance that they don't, we're going to be okay, right? Because again, it all comes down to that asset coverage in a downside scenario.
Yep. And so many of these loans, again, if they're more just based on the cash flows, that's plan A. The company pays you back, it goes well. If it doesn't work out, what does that look like? So we really like to be with managers who have a plan B, sometimes C. So the more plans I get, the happier I am.
And real quick on that, even going back to your quadrants, you hit on it. I mean, think about any quadrant in that matrix we showed. Yeah. This loan it's really sort of outside of those quadrants to some degree. Knock on wood, it's going to be the green color. It's going to behave well in any of those environments.
Okay, great. All right, well, that wraps it up for today. We are not going to have a third quarter update because we are having our 4th annual investor symposium. It is October 22nd at the Westlake Village Inn, and we very much hope to see you there. But thank you so much.